Rivian Automotive, RIVN, closed its last trading session on Friday, May 1, 2026, at a price of $15.02 per share, marking a significant intraday decline of 8.41% from its previous levels. While the market is currently closed this Saturday, May 2, 2026, the after-hours activity showed a slight corrective nudge upward to $15.10, but the weight of the Friday sell-off remains the dominant narrative. Most investors looking at this price action see a company that just reported an earnings beat and yet got punished by the market, creating a classic disconnect between headline numbers and investor sentiment. You would think a 47% surprise in earnings per share would send a stock soaring, but the reality is that the market is no longer trading Rivian on its ability to lose less than expected. It is trading it on the sheer velocity of its cash burn and the massive execution risk tied to the R2 platform. The immediate insight here that most people are missing is that Rivian is effectively becoming a software and services company disguised as a hardware manufacturer. While the automotive gross profit saw a loss of $62 million, their software and services segment grew by a staggering 49% this quarter. This is the hidden engine. Investors who are only tracking the number of R1T trucks leaving the factory are looking at the wrong ledger. The expectation was a hardware-centric recovery, but the reality is that the path to profitability is being paved by high-margin digital subscriptions and fleet management software. If you're using platforms like Interactive Brokers or checking your individual brokerage on the Fidelity mobile app, you've likely noticed the volatility spikes that happen every time a production headline hits. But the real story is in that 9% overall gross margin improvement that is quietly decoupling from the raw manufacturing costs. We have to talk about the common ground first. The general belief is that Rivian is a Tesla killer that is simply struggling with the same high interest rate environment as everyone else. People see Rivian stock and think of it as the premium alternative to the Cybertruck. But I want to challenge that. Rivian isn't competing with Tesla anymore. They are competing with the traditional luxury segment's inability to innovate. The tension here is that while the market expected Rivian to scale the Georgia plant immediately, the company pivoted to focus on the Normal, Illinois facility for the initial R2 launch. This saved them over $2 billion in the short term, yet the stock dropped because the market viewed it as a retreat rather than a strategic consolidation. It's a classic case of the market demanding growth at all costs, while simultaneously punishing the company for the capital expenditures required to get that growth. The trading volume on Friday was massive, hitting 53 million shares, which is nearly double the 3-month average. That kind of institutional activity suggests a major reshuffling of positions. When you see volume like that on a down day, it's often big players moving to the sidelines or hedging their bets. Whether you are using Robinhood stock trading for quick moves or managing a long-term position through Schwab Intelligent Portfolios, you have to recognize that the big money is nervous about the $4.8 billion cash pile. At the current burn rate, that gives Rivian a limited runway before they need more capital, despite the $1 billion influx from the Volkswagen partnership. The expectation was that the Volkswagen deal would provide a permanent floor for the stock, but the reality is that it only bought them time, not a free pass on execution. Looking at the institutional side, we are seeing a shift. Fidelity Investments and various Fidelity ETFs have significant holdings here, and the way these funds rebalance will dictate the medium-term price action. If you're looking for investment help or using investing sites to track institutional flow, keep an eye on the 13F filings coming up. The reality is that institutional ownership still sits at over 60%, which provides some stability, but the retail sentiment on the Robinhood app has been much more flighty. This creates a tug-of-war where the long-term thesis of a vertically integrated EV powerhouse is clashing with the short-term reality of a company that is still losing money on every vehicle it delivers. It's a high-stakes game of chicken with the balance sheet. Comment below how many shares of Rivian stock you currently hold, or if you think the R2 will actually be the turning point for their profitability. I'm curious to see if you guys are buying this dip or waiting for the sub-$12 levels we saw earlier in the year. The company's business model is fundamentally different from a traditional automaker like Ford or GM. Rivian controls the entire stack, from the battery pack design and the drive units to the software that runs the infotainment and the autonomous features. This vertical integration is why companies like Volkswagen are willing to hand over billions just to get a look at the architecture. In the past, the R1S and R1T were proof of concept. They proved that Rivian could build a world-class product. But the business model is now shifting toward the R2 and R3, which are designed for mass market appeal and, more importantly, easier manufacturing. They've eliminated miles of copper wire by moving to a zonal electrical architecture, which is a massive win for margins that hasn't fully reflected in the stock price yet. Recent stock movement has been a roller coaster. We saw a climb towards 17 earlier in April, only to have those gains wiped out in a single session. This is why self-investing in the EV space requires a thick skin. If you are active in online investing, you know that sector momentum is currently favoring legacy players who are pulling back on EV plans, while pure-play companies like Rivian are being forced to prove they can survive the valley of death between low-volume luxury and high-volume mass market. The macroeconomic pressure of sustained high rates is making the invest online crowd favor cash flow positive tech over high-growth pre-profit industrials. Now, let's look at the future catalysts. The biggest one is the spring 2026 delivery window for the R2. If Rivian can meet that deadline without further delays, the narrative shifts from can they survive to how big can they get.
There is also the autonomy roadmap. They are targeting a 2026 launch for point-to-point autonomous capabilities. If they can execute on software as well as Tesla, the valuation gap could start to close. However, the risk is real. Any supply chain hiccup or a further decline in consumer demand for premium EVs could force another round of dilutive funding. This is the tension, the expectation of a tech-led recovery versus the reality of a capital-intensive manufacturing business. The Schwab Intelligent Portfolios and other robo-advisors often look for stability and trend confirmation, which Rivian currently lacks. If you are doing your own research on the Interactive Brokers platform, you'll see that the implied volatility is through the roof. This isn't a stock for the faint of heart. It's a bet on RJ Scaringe's vision versus the cold hard math of a balance sheet that is still in the red. The Fidelity trading platform shows a lot of sell ratings from analysts who are focused on the 2026 EBITDA Dow loss guidance of $1.8 billion to $2.1 billion. That is a lot of money to lose in a year, and until that number starts to shrink significantly, the stock will struggle to find a permanent uptrend. To wrap this up, Rivian is at a crossroads where the expectation of its demise is being challenged by surprisingly resilient operational execution, yet the reality of its financial burn keeps the ceiling low. We saw a beat on the top and bottom lines, a massive growth in high-margin services, and a strategic pivot to save cash, yet the stock is down 8%. This tells you that the market is currently in a show-me phase. It doesn't want promises, it wants to see the R2 on the road and the gross margins turning positive. The contrast between the company's technological success and its market performance is at an all-time high. Whether you use SoFi Invest for your active trading or keep it simple with Fidelity mutual funds, the lesson here is that in this high-rate environment, even a great product isn't enough to satisfy the reality of the market's demand for profitability. Authority in this space comes from execution, and for Rivian, the next 12 months will be the ultimate test of whether they can bridge that gap. Expect more volatility, but keep your eyes on the margin improvements, not just the delivery numbers. That is where the real story of Rivian stock will be written. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.